Let's spend 4 minutes to understand the language of investment that can make you millions. Welcome to the journey of mastering the top 10 investment terms. As the saying goes, knowledge is power, and in the world of finance, this power can translate into substantial wealth. Our goal today is to simplify these terms, breaking them down to their core concepts. This will enable you to make informed decisions, maximize your potential returns, and minimize your risks. Ready to take the first step towards your financial freedom? Let's dive in. Starting with number 10, diversification. It is the strategy of investing in a variety of assets to reduce exposure to any one particular asset. Think of it as spreading your investments like seeds in a garden, hoping to grow a rich and diverse financial ecosystem. Now let's move on to asset allocation. This is how an investor divides their portfolio among different asset classes. It's like choosing what types of plants you want in your garden. Remember, don't put all your eggs in one basket. Diversify and allocate wisely. Moving to number 8, NASDAQ. This term represents the tech-heavy stock exchange where giants like Apple and Microsoft trade. NASDAQ is more than just a place for buying and selling stocks. It's a barometer of how well the technology sector is performing. Now let's shift gears to the S&P index, also known as the Standard & Poor's 500. This index is a collection of the top 500 companies in the US across various sectors. It's a broader measure of the market and often used as a key benchmark for US economic health. Finally, we arrive at the Dow Jones Index. This index consists of 30 large, publicly owned companies based in the United States. It's one of the oldest and most watched indicators of the US stock market's performance. From tech-centric NASDAQ to the diverse S&P and the focused Dow Jones, these indexes can be a good indicator of the market's overall health. Halfway through at number 5, we have risk-reward ratio. This is the comparison of the potential profit of an investment to its potential loss. It's like weighing the scales of gain against loss. The higher the potential reward compared to the risk, the more attractive the investment may seem. But remember, higher rewards often come with higher risks. Now, let's move on to cost averaging, a strategy that's as steady as a tortoise in a race. Picture this. An investor divides the total amount to be invested across periodic purchases, regardless of the price. This approach can reduce the impact of price volatility on large purchases. It's all about maintaining a consistent investment amount over time rather than trying to time the market. In the end, it's a game of balance. By understanding risk and using cost averaging, you can navigate through market volatility. Coming in at number 3, dividend reinvestment. This is when the dividends received from a stock are used to buy more of that stock. Instead of taking a cash payout, you're essentially rolling your dividends back into your investment, allowing your stock holdings to compound. Now let's shift gears to stock dividends. These are dividend payments made not in cash, but in the form of additional shares. It's another smart way to expand your portfolio. Reinvesting dividends and understanding stock dividends can significantly grow your investment over time. Finally, at number 1, the magic of compound interest. This is interest calculated on the initial principal and also on the accumulated interest of previous periods. Imagine a snowball rolling down a hill, growing bigger and faster with each turn. That's compound interest for you. It's the secret sauce that can exponentially increase the value of an investment over time. It's not just about making money, it's about making your money work for you. Remember, compound interest is the 8th wonder of the world. He who understands it earns it, he who doesn't pays it. Stay financially savvy.